What the heck is a fixed rate mortgage? Well, that's what I'm going to explain in this video. When I got started in real estate investing, I had only rented properties. I was still in college. I'd never gotten a mortgage myself. I didn't even really understand how a mortgage worked. I didn't know that there was different types of mortgages out there. And so if you're watching this video and you're kind of perplexed as to the different types and what the different options are for a mortgage, whether you're looking to buy your first home or you're looking to buy a rental property and get financing for it, or you're like me and you're a note investor or you're getting started in note investing, it's important to understand the different types of mortgages available out there and some of the pros and cons, especially if you're a real estate investor and trying to make cash flow or make a profit or, keep your business going, right? So today I thought I'd start and talk about a fixed rate mortgage. And keep in mind, different countries have different definitions for a fixed rate mortgage. For example, in Canada, we can get like a 5-year fixed rate mortgage, which means that the interest rate is set for only 5 years, and then it's going to change on you, okay? Whereas you lucky Americans out there, if you can find yourself a 30-year fixed mortgage, which is pretty common, whatever interest rate you get in day one, that's going to be your interest rate for that entire 30 years. So if you were lucky and bought a home or bought a property with financing 2 years ago when the rates were like 2% and you got a 30-year fixed rate mortgage, what that means is you have 30 years to pay off that mortgage, and your interest rate that's going to be charged on that mortgage is set for 30 years. It's not going to change. It's not going to fluctuate with market conditions. You're lucky enough or unlucky if it's a high rate, but your interest rate is going to be set for that entire length of that mortgage, okay? So there's lots of different term lengths or amortization rates or lengths available. Like I said, the 30-year is very common in the US. Right now in Canada, you can't even get a 30-year mortgage, and you haven't been able to get that in a very long time, although I hear they're talking about that. But you can also find 25-year fixed, 20-year fixed, which is a little bit more common in the US. Sometimes you can even find like 15, 10, even 8. And some of these smaller term lengths or amortizations are more common when you're buying a house with owner financing, where you're buying the property from the previous owner and they're going to finance it for you. So they're going to create financing for you. And a lot of times you might be negotiating with them and they don't want to wait 30 years to get all their money back. So they might say, hey, put 10% down and we'll do a 10-year fixed rate mortgage or 15. Okay. So a lot of times if you come across those shorter terms, that's usually because it's been originated as an owner financed mortgage. Whereas those 30-year fixed rates are more common for institutional lenders, banks, and lending companies and things like that, okay? So as a note investor, if you're buying mortgages as an investment, especially if you're looking to buy performing mortgages where you're collecting the payments from the borrower every month, it's very important to know the difference in what kind of mortgage note you're buying. So a fixed rate is the easiest to understand. It's very common. You're going to see a lot of this, which makes it really easy to crunch your numbers because you know that principal and interest payment that's coming in from your borrower, it's going to be the same every month because that interest rate's not going to change, okay? Unless something happens and you have to, negotiate with your borrower or modify the loan, but it's going to be set. So when you're analyzing a note deal for a potential investment, it's really easy because you know what that payment and interest rate's going to be the whole time. Okay. And that's what I suggest you start with if you're getting into notes, is a fixed rate mortgage. Okay. Now, also, if you're buying a property subject to, which this is a really cool investment strategy that you can do, if you can find a seller that's willing to sell you their property subject to their mortgage staying in their own name, staying on that property, then you got to be careful what kind of mortgage it is. Okay, what kind of, if it's a fixed rate or a adjustable rate or interest only. Okay, but if you're buying subject to and it's a fixed rate mortgage, again, that's good because you can now understand what your payment's going to be to the seller's mortgage lender. And then if you go and rent that property out, keep it as a rental, it's easy to know what your cash flow is going to be. Or maybe if you turn around and do an owner finance wrap, it's easy to know that you're going to have positive cash flow the entire time. Whereas if the rate's changing, which I'm going to talk about in my next video with an adjustable rate mortgage, it can be really challenging and even risky because some months if that rate goes up, you might not have any cash flow from your rents that are coming in or from your owner finance wrap. Okay, so if you're buying subject to, really check and make sure you know what you're doing, and if it's a fixed rate mortgage, that makes it a lot easier. Now lastly, if you're buying a home, your first home, or you're buying a home on a fixed rate mortgage, is pretty common. If you're buying a rental property, same thing. There's a lot less risk, even for your own household, right? If you know what your payment's going to be, it's easier to budget your day-to-day expenses to make sure that you have enough to pay that mortgage. Whereas if the interest rate's changing on your mortgage all the time, it can be really scary if it goes up too high, because you might have cash flow problems, right? If you have a fixed income. And same thing if you have a tenant in the property and it's a mortgage on a rental property. It's a little bit risky if you don't know if you're going to be able to make that payment out of the rent, because the rate's changing. So all in all, I like fixed rate mortgages. It's just easier to plan. You know what the payment's going to be for the entire length of the mortgage. I hope that's helpful. In the next couple of videos, we're going to talk about some of the other types of mortgages, like interest only mortgages, adjustable rate mortgages, and that kind of thing. I'm Cal Ewing, and if you like this video, give it a like. Feel free to subscribe, because we talk about mortgage notes and real estate and all that fun stuff, and I look forward to having you follow this channel.